Hello there, opening great as always. So let's make some good decisions and money in the stock market because those two are linked together, right? The better we are, the smarter we are, the higher quality decision we make, the more money we make in the long run, right? As I wrote on Twitter a couple days ago, and this is actually something that I've wrote already a couple of times over the years. But in essence, you might like it or not, but money is, although imperfect, but proxy for competence, right? The people who are better, faster, more skilled, more educated make more money, right? It all comes down to the quality of decisions, right? Especially in the stock market. So let's continue where we left off last time. Now we are on the page 10 out of 17, lesson number 6. So what I've learned over those past 8-9 years of investing, building my $1.8 million portfolio. Well, one of the important points that exactly as I've just said, right? It took 8 years. It's definitely not nothing. So consistency kills. Investing is half brain power and half stomach. Ability to withstand volatility of your portfolio and keeping going is paramount, right? Because those 8 years, they definitely were not easy, right? There is always something going on with the market. Just remember, just 5 years ago, 2020, COVID crash, the whole pandemic thing, portfolio and the market overall, plunged 30-40%. And all of, like we have to have that mental fortitude to withstand all of this, right? There is, it's not coincidence that people often describe stock market as a roller coaster with highs and lows that can make even most experienced investor feel uneasy, right? Because sure, it's one thing to talk about it, just between the two of us, right? But the other thing is to actually live through it. When you see our portfolio, let's say, back in 2020, I had the first 100K in my portfolio, right? And then suddenly see, basically 40,000, 40% of my portfolio just kind of evaporated in a sense, right? And that was a lot of money for me back then, right? And it still is in an absolute terms. But we have to be able to, like be ice cold even when this happens. Because as a long-term investor, it's crucial to have the ability to mentally withstand these fluctuations. As trying to time the market or making impulsive decisions based on short-term changes can be detrimental to our portfolio, right? So in those moments when it's hard and the market's going down, we cannot panic, right? The people who panic might sell out, might make some imperfect decision, might want to jump from a company to company. No, like all of the decision, they need to be thought through, calculated decision, right? And that's actually one of the benefits of being a long-term investor, right? Because we can ride out all of those market fluctuations. And that means that even if the market experiences downturn, we have the ability to wait, recover, and what to do in a bad market. Well, don't look at our portfolio and be mad or sad or whatever emotion you want to describe when you see your portfolio going down. It's the best time to just go and make more money to invest, right? That's the best time to deploy new cash in the market, right? Either from the reserves or let's go and let's make more money, right? So we can invest and use it. So instead of feeling sorry for ourselves, well, we can use it to fuel our ambition. My portfolio is down, perfect. I can go and put more money in to get even juicier returns, down the line, right? I don't want to be buying at the all-time highs. I want to be buying when there are discounts. And so we have to have that mental fortitude to resist the urge to sell when the market is down, which can be difficult when you see the value of your investments just like going down, and you're like unsure. Okay, well now it's down 20%. Is this the end? Is it going to go down another 10%, another 20%, right? Or is it going to go up now? It's like, should I sell and buy later? No, like those are wrong decisions, right? We have to make sure that we are following the plan. And one way to, of course, improve our ability to withstand the market fluctuation is to have robust portfolio, right? Having clear investment strategy, stick to it, stay focused on the long-term goals, have the long-term price targets for the companies, right? If I think that XYZ company is going to go to $100 a share in 5 years, It doesn't matter if, short term it's, 20, 30, 40, goes back to 20 again, right? As long as that long term thesis is intact, right? Because at the end of the day, Warren Buffett has been net buyer of stocks since he was 11-year old. 11-year old, right? The guy was, that's the epitome of, just stacking one good decision, one good company on top of each other, right? Just keep investing regardless of what's happening for years and years and years and years. And we have to do the same, right? Amass massive fortune. So it's important to get that long-term perspective when it comes to our investment portfolio. And of course, it's natural to see immediate returns on our investment. And understand that stock market is a long-term game. And it's a little bit against our, biological wiring, right? Because as a human, as a, kind of like the primitive, monkey, we want to have everything now, right? We want to, get that kill over there, go on a hunt, get it, eat it, because we don't know what's behind the horizon, right? At least that's how it was for thousands and thousands of years, right? You weren't sure that you're going to survive even, another couple nights, right? So everything was going for that immediate satisfaction, immediate survival. Not anymore. Now we can plan in years and decades, right? And it's only a small number of people who are actually really innately understand this, right? So that's what we have to do. Understand that long-term gain, focusing on that long-term growth of our investment, and stay focused on our overall financial goals, right? And we also have to resist the temptations. Because in the stock market, there are many players that benefit from market movements, right? Because sure, we are the long-term guys, we have Warren Buffett, Peter Lynch, we understand the long term. But there are lots of people playing lots of games in the market, right? And also many institutions, right? And those people often make money regardless of what's happening, whether market goes up, down, sideways. There are people or organizations that make money all the time, right? Trading houses, whenever, especially traders, right? The more transactions they are making, there is always that little tiny fraction that the broker is getting out of all of the trades, right? They're not getting anything from a long-term investor. They just get that one commission when it's, kind of bought initially and then nothing for years. Well, so what's their incentive? Well, their incentive is to make people to trade and go in and out and options and, things like that. That's companies like Robinhood, right, that are incentivizing that behavior of, risk and almost borderline gambling, speculation, right? And same, of course, goes for, all of the money managers, right, who for whom it doesn't matter if they, make their clients a lot of money or just little money or just stay in the index fund, as long as they have lots of clients and get more clients, right, over time and collect their fees, right? So there are banks, the market makers, speculators, hedge funds, day traders, algorithmic traders, right? And people, grifters selling you some of the small penny stocks, things like that, pumping their bags. You have to cut through all this BS, right? The market itself wants you to be active, trade in and out and extract fees from you if you invest in ETFs or more exotic funds, right? Because also same goes for ETFs, right? So you're getting some thematic compilation of a company's, some, fund of a fund, and the fund has a fund inside, and then there is a fee on top of fee, right? So why would you buy some, ETFs which kind of are like spread, but you can do the same, right? Like you want to have as little in between you and that real ownership, right? You want to be the direct owner, right? You want to own the company. You don't want to own a fund that owns a couple companies. No. The less layers, the better, right? Market makes very little from someone who just buys and holds for years, right? With my portfolio here, what did my broker get? just a little commission when I was buying those companies. That's it, right? But you have to resist that urge that market tries to incite. Resist the seduction, right? Because if you get swayed by the temptation of get rich quick, you will never get wealthy, right? Because for getting rich quick, it is more reasonable to build a product or business. So I will stress this once more. Contemporary long-term investing is a wealth multiplier, right? It should never consume all of our time, while simultaneously it should have one of the highest levels of impact of our overall net worth. Once we cross six figures, we might as well find out that our net worth is rising faster than our than the money we make through earned income, right? Like over my whole life, kind of like adult life, this portfolio here, I have over $1 million in gains. My gains on investments at this point in my life are already higher than my earned income over those past roughly 10 years I've been working. Already now. If you're a good investor, this should happen within a decade. Or, decade, 15 years, let's say, depending how aggressive you are, how much you're investing. But it should be inevitable for you to reach that point where your investments are having bigger impact on your net worth than earned income, right? And it's also great because in most parts of the world, earned income is actually taxed the highest, right? Investment income enjoys many benefits, right? Especially, let's say just a quick example, right? In the US, if you have a long-term capital gains, it's just 15% compared to, your earned income, which is, different brackets, and you're paying much, much more. Like, the system is set up to benefit long-term investor, right? And of course, we should also avoid excess risk, the kind of risk that might ruin us. And we should aim for a healthy and calculated level of risk. The risk we understand and the risk we can emotionally withstand, right? And of course, we learn that through experience. Sure, there are many guides, rules of thumb, but every person reacts to risk differently. So it's also a little bit like a discovery process, right? When you become an investor, over those first 3 years of investing, it's a test, right? You cannot judge yourself, after the first couple months, after the first half a year, that long-term track record. And if you do things right, you will only realize that if you're doing this seriously, maybe, let's say in the first 2-3 years, I would say, right? And that's why it's even more important to really give it what it's needed. Because what's the risk is also that you will just do it kind of half measure for a couple of years, and only in 3-4 years and you realize it's not working. Tough luck. So, and this applies for anything in life, right? If you're doing something, do it well. No half measures, right? And then of course, especially this guide is specifically, to first 6 figures, right? So this is for those early stages of a little bit aggressive portfolio building, right? Because of course, ideally we should have some, let's call it 6 months worth of expenses in our rainy day emergency fund. Of course, raise that number if we have some people depending on us. But never allow yourself to have too big of an emergency fund. You want to invest everything above that, especially under 6 figures, right? We should be slightly uncomfortable, at least that's more for me. And I went even more aggressive than that, especially during that 2020 COVID crash. I basically drained everything. I definitely risked a lot back then. But again, generally speaking, we can always get more money, right? And we should be able to push ourselves to also invest more, right? Because sure, you can get to that million even with 500, 600, 700, but ideally we should put at least 1,000 into the market, right? I mean, again, if you're doing something, we should do it properly. So let's call it 1,000 even, if we want to get to million in decade, 15 years. And tied to that is also the point of setting the financial goals, right? Because if we want to know how to set up our portfolio, we also need to know what kind of investors are we. What's our goal, right? Because it's of course not like one size fits all, right? I'm not telling you here to do things exactly as I'm doing them, but figuring out what works for you, right? Take from different sources, of course you might listen to me here. There are plenty other much smarter people than I am, right? But figure it out how it makes sense for you, right? Do you want more defensive portfolio? Do you want a passive income? Are you looking for dividend portfolio? Do you want to aggressively grow wealth? Because my specific goal here is to create wealth over time. And we want it to grow into something spectacular, right? So once again, we have to get some decent income, put it into the stock market, right? Try to minimize fixed expenses, right? Look at how much of expenses we have, how much is necessary. Because for many people, it's also a little bit of an expense problem, right? So, if we don't have that at least 1,000 a month to invest into the stock market, we have to ask ourselves, is it an income problem or an expense problem, right? Should I, and of course, usually it's better to, try to raise income. That's always, the ceiling is infinite, whereas expensive can only go so low. But if we are, spending some, money on, I bet many people, might easily find a way how to slash extra 300, 400, 500 a month of expensive that can suddenly be funneled into something, positive, like a stock market, right? So there are probably many people in situation where they might invest, I'm investing 400, 500 a month, but if they looked at their expenses, they could find another 300, 400, right? And suddenly it's completely changing the situation, right? So, and when we have that good idea of our income, expenses, we can see what percentage do we want to invest. And again, in this point, in this PDF here, I'm aggressive, right? Like, we should invest at least 50% of our income, preferably more. And I was doing that even when I was starting to invest, right? Because if we go back those 8 years ago when I was still student, I was basically working, I was studying while simultaneously working basically full-time in a restaurant. And I was making like a 33, 35, 3,700 a month, right? Depending how many shifts I've taken, right? So let's call it roughly 3K a month, right? Just to make the number simple. And even then, 3K a month, and I was still investing roughly 2K, right? Roughly. Because my expenses were also minimal. I had just like one tiny studio, right? I wasn't paying much for groceries as I was working in a restaurant, right? So I was basically investing like roughly 2/3 of my income back then, right? And of course, if we make more, we should, that should be even higher percentage of our income, right? If someone's making a, decent amount, if we are making, let's say, 6-figure a year, right? Well, let's challenge ourselves a little bit, right? Can I get that percentage of an income that's invested higher? Because it's going to drastically improve what we can achieve in those 10-15 years, right? The more aggressive you're investing, the sooner you get to insane numbers. And risk and return. So risk and return are two important concepts in investing. Risk refers to chance that an investment's actual return will be different than expected, right? Because with investing, of course, we are always dealing with uncertainty. And we are making decisions based on incomplete set of information, right? And frankly, that's, most decisions in life are with somewhat incomplete set of information. And so investment with higher risk has often, but not always, potential for a higher return, but also greater chance of losing value. On the other hand, an investment with lower risk has lower potential return, but also lower chance of losing value. But here's the thing. Many people might perceive something as risky, but that risk can often be mitigated by going back to the first point, being more competent, knowing more, right? So what for one person might seem like a risky gamble is not that risky for that other person who've actually done the work and understand, let's say, the given company really in depth, right? If you tell me a random ticker of a company I don't know nothing about, even if the company is quote unquote safe, I would consider it risky for me because I don't know that company. But the company I know and I've done the numbers is not that risky because I've done the numbers, right? So many people kind of visualize that risk reward as a little bit like a going against each other, right? Okay, riskier investment, higher return, more defensive investment, lower return. But it's not always like that. And it's our point, our goal to find these discrepancies, right? Where something appears to be high risk, but it's actually not, right? So that's what we have to find, and that's where, you know, some of the hidden gems are located. And number 9, asset allocation. So asset allocation and diversification are two important concepts for a beginner investor to understand, right? Asset allocation refers to how you divide your investment among different types of assets, not just talking stocks, right? It could be stocks, bond, cash. And the idea is that you want to spread your investment across different asset classes to reduce the risk and so on, right? And sure, it works to a certain degree, right? But again, it's quite individual. And if we know what we are doing, we can be more concentrated, right? So of course, someone who's just doesn't want to do, let's say, anything, right? Just really keep it simple. Sure, they want to diversify across many different to spread out the risk, but also basically get mediocre returns at the end of the day, right? So basically, you know, oftentimes, you know, especially money managers and big banks, they're just trying to pigeonhole people and, hey, you know, you should do it like this, you know, we'll spread your money into these different piles and, you know, act all smart about it. They're like, oh, you're diversified, you're protected. Well, yeah, you're protected from gains, right? So, you know, if you know what you're doing, you should be more concentrated, right? But again, it's not easy. But hey, that's why we are here, right? To get smarter. So get that information from wherever you can. Videos, books, Twitter, YouTube, you know, whatever you get your hands on. Spend those, you know, couple hours a week connected with the stock market, right? Learning how it breathes, learning how it behaves, connect with other people, you know, ask how they've done it. Learn the income statement, learn the balance sheet, you know, learn that language of business. Because in 15, 20 years, you'll be glad you did. And yeah, that's about it for today. So we'll give it one more go, probably tomorrow, another couple points. But yeah, remember this. Appreciate you.